You must have seen people making a fortune by trading on social media. Their lives seem great. They know when something's price will go up, put money into it, and cash out when it rises. And it doesn't even look that hard. They study charts, use a few indicators, draw lines, follow the news, and keep adding to their wealth. But what if I told you that you can't actually make money this way, and that even the trading gurus you see on social media don't really make their money this way? Now we'll uncover why trading is actually the worst way to build wealth and see which approach truly lets money make money. Trading is the buying and selling of financial assets to make a profit, usually by taking advantage of small price movements. The core idea is simple: buy low and sell to someone willing to pay more. To spot opportunities, traders often use technical analysis, studying price charts and indicators built on algorithms. The difference between long-term investing and trading is that investing focuses on the value of an asset, while trading is mostly speculation. That's why the specific asset you buy doesn't really matter when trading. You can trade anything you want, from gold and stocks to Bitcoin or even meme coins. When making a real investment, you need to evaluate the asset from every angle. Your reasons for investing should be clearly defined. You need to know your risks and expectations. In short, when you have rational reasons, you can start looking at it from an investor's perspective. You no longer rely on someone paying more than you. Instead, you can trust in the quality of the asset you're investing in. If your investment is long-term and based on rational decisions, market downturns won't upset you. On the contrary, such drops create more opportunities to buy. If you're trading, every downturn hits your pocket directly because you won't be holding the asset tomorrow or next week. When trading, you settle for small percentage gains. And since you're usually working with smaller amounts, combining a small percentage with a small capital leaves your profits minimal. In long-term investing, however, you keep most of your capital in the game, and small ups and downs don't really matter to you. The real point here is not the profit, but whether you've put your savings in the right place. If you still trust the asset for the same reasons, 5 years from now, there's no reason to sell. Selling shouldn't happen just because you see a profit, but when you believe the investment no longer makes sense. On top of all this, trading can trigger a luck mindset. After a losing trade, you might think, "I'll get it right this time," and trap yourself in a cycle. With each loss you try to recover, the snowball effect can lead to losing everything. Take a moment to ask yourself, is it really worth spending the money you worked and saved for years to risk it this way? Research shows that out of every 100 traders, only one achieves consistent long-term returns. Do you think you can be in that 1%? If so, you need to be certain about the reasons behind it. When trading, millions of people are trying to make money alongside you. To succeed, you would need to be ahead of them in the news flow. Will a war break out tomorrow? Will presidents make sudden decisions that tank the markets? What will happen in global politics? Can you learn all of this before every other trader? Because if you don't get early access to such sudden moves, you can lose everything. With powerful politicians, bureaucrats, and business leaders controlling much of the information, can you really be sure you'll get the news before everyone else? Besides that, you'd need a powerful algorithm, substantial capital to risk, and access to extensive information. But things are different with long-term investing. The longer the time horizon, the more reliable information becomes. You can buy shares of a company that's announcing new investments. Profits may take years, and the stock price might not rise right away. However, if you know that the returns of these investments will come in a few years, you'll profit when the time comes. You don't need access to secret archives for this. The true power of information shows up over the long term. Here, the patient and informed stand out from the impatient and uninformed. While a trader might take a profit and run after a 3% gain, a true investor who understands the reasons behind an investment can put substantial capital into the asset and earn a 1,000% return when the time is right. In trading, the reasons you lose or earn money are often unclear. The market might just drop 5%, and that's normal. Following short-term price movements is usually impossible, and those small drops can wipe out your entire savings. Because this environment is unpredictable and irrational. If you truly believe you can be that 1 in 100 trader, go ahead and experiment. But if you know you're not, it's better to stop trading and focus on long-term investing. This path makes your results more reliable and profitable. All it takes is a little patience. You shouldn't fear market drops. If you've analyzed your investment correctly, instead of chasing small profits from short-term price swings, focus on increasing your savings rate or your income and growing your portfolio. Rest assured, the time you spend researching investments or creating new income streams will be far more rewarding than the time you spend trading. Like this video and subscribe for not miss out next videos. See you next week in the next video.